Hey everyone, Rob B here with Rob D, and you are listening to the Property Podcast, and this week we're going to bring you right up to date. The mortgage market, it feels like it's all over the place right now. People seem to be craving the answer to what should I do right now? Well, we've brought a mortgage expert onto the show to give you all an update to what's happening in the market and give you guidance on what type of product you should be using right now.
Welcome to the Property Podcast. Thank you for joining us. This is the show where we take the knowledge that we've gained over the years and bring it to you for free. But today we're not just doing that, we're combining that with someone else's knowledge as well. We love bringing in experts to make sure you have the best information on the important topics that affect you. And there's no more important one of those right now than mortgages. So I'm really excited about this episode. And make sure you stick around to the end, because in Hub Extra, we're sharing a tool that we've both started using recently that's making us way more productive.
So let's kick off with a news story. And Rob, this week's news story is quite alarming.
I refuse to acknowledge that pun and we'll move straight into the news story, which does happen to be about smoke and carbon monoxide alarms. And the reason for mentioning this is there's a change in the laws around this that's coming in from the 1st of October. It's been talked about for a really long time, but it's one of these things where often this legal stuff gets talked about for so long that you can easily forget about it by the time it actually comes into force. And some landlords are not the best at keeping on top of this stuff, so consider this a public service announcement. There are two changes in these new regulations. One is around smoke alarms, but actually that's not a change for the private rented sector. Since 2015, every private rented home has needed to have a smoke alarm on every story of the property that's used for living accommodation. So if you don't have that in your properties, sort that out right now. But the law is now changing so that applies to socially rented homes. Kind of bonkers that it didn't before. I just kind of assumed that it did. But the other change is around carbon monoxide alarms. All private rented homes now must have a carbon monoxide alarm in any room used for living accommodation where there's any kind of fixed combustion appliance, which includes gas boilers, with the exception of gas cookers. So previously, you only needed a carbon monoxide alarm in a room where there was a solid fuel burner like a wood burner, but now it's any kind of device. And as you would expect, you need to make sure that these are actually working at the start of every tenancy. So if you self-manage, that should be part of your checks. So hopefully this is something that all listeners do already. But if not, you've got a few weeks to put it right. And fortunately, unlike lots of other changes that get introduced, this is a very quick and easy one to put right.
You know what, Rob, puns aside, this is why I love what we do, because it's so easy to miss these stories. You know, as property investors, we have so much going on, and we have so much going on in our lives that you can think, okay, where am I up to with all the law and legislation? And we will do our best, as we always do, to bring you all this information so you never miss a beat and you're always on top of the things you need to be. And slightly less serious news, but quite exciting for us. Our portfolio logo has been rebranded, refreshed. Now, there's an interesting story about that, and maybe I'll talk about that on LinkedIn. This isn't a business podcast, but it looks gorgeous. It's been updated. It's beautiful. Well done to Rachel, our designer, who's created it. It looks fantastic. And for me, it's an upgrade on what was there before, and the app will now look even better than previous. If you're using Portfolio, then great. Go in and check the app. You can see it. If you're not, then you can go and check out the app. You don't have to use it, but if you're curious, go to the App Store, whichever one you use, and search for Portfolio, or go to portfolio.co.uk and you can see the new fancy logo that we have. We're very proud of it here at Portfolio and Property Hub. Go and check it out. You might not be as passionate as us, but it's always nice to see nice work being done. So well done to Rachel, who's put that together. So go and take a look and enjoy our new rebrand.
Mortgages are always a hot topic among property investors, as they should be. Mortgages, for us, as we talked about on the show before, are not something you use because you can't afford to pay cash. They're a tool that you use as a property investor to supercharge your returns. They're such a critical part of the approach to property that we take personally. But at the moment, they're an even hotter topic than ever before, and not necessarily in a good way, because mortgages are getting more expensive. And they're getting more expensive because the base rate, as set by the Bank of England, has finally started increasing, and there's the potential for more increases in the future as well. This, for the first time in a long time, has created a dilemma for investors, because in recent history, rates have been so low that it's just not an issue. But now investors are having to make tricky decisions, including how long to fix that rate for. At a time of so much change like there is now the time to lock in and avoid future uncertainty, or potentially hold off and get a better deal when things settle down again. That's just one of the things that we're talking about with our guest today, who is mortgage advisor Nick Shepherd. Nick has over 20 years experience in the industry and is an investor himself. So we're super happy that he agreed to come on the show and share some of his knowledge with you.
So when we spoke to Nick, we had to start with the big one, interest rates. And we wanted to know, with it jumping up over the last 9 months from 0.01% to the lofty heights of 1.75%, how is this affecting mortgages? So to start with the obvious, Nick, are mortgages becoming more expensive?
Yeah, well, products are definitely becoming more expensive. If I focus on buy-to-lets, the key is understanding for clients is understanding how lenders are funded. It's the cost of funding that's driving the hike now, the cost of funding for the lenders. So a lot of specialist lenders increase their rates because they have to. They want to remain competitive. But when you move into the specialist world, often businesses won by criteria rather than by interest rate. In regards to how they're funded, your bank-backed lenders, buy-to-let lenders, metro banks, etc. They're balance sheet lenders, which means they lend retail customers money, so the bank's money. And these products are often cheaper. Securitized lenders are funded by institutions, and that rate of borrowing there is pinned to the SONIA rate, which is dramatically increasing at the moment. And the SONIA rate reflects the interest banks and institutional investors are paying to borrow funds at the moment. So if clients are keen to see how specialist lenders are funded, keep an eye on that SONIA rate. And if that keeps on going up, then you can infer that mortgage rates for specialist lenders will continue to increase as well. Lenders do want to remain competitive, but the sentiment is also that they want to kind of manage their own capacity as well. In a busy market, we often see rates increasing to deter business, essentially, to allow lenders to clear pipelines. And lenders also want to sit in a certain place of the market. If you've got a personal name buy-to-let, you've got your top 5 banks, and outside of that, your smaller lenders will want to sit below them. So it's a melting pot, essentially, of reasons. Yes, it's becoming more expensive. Cost of funding is expensive for lenders. And capacity is also really important as well within the lenders.
So what are the margins that lenders are operating at? Is there the opportunity for them to reduce their rates?
If I focus on the specialist buy-to-let world, the lenders want to remain a viable business. So if the cost of funding continues to increase, then the rates they're offering clients will have to increase. For example, there's some of the specialist lenders are completing transactions at the moment on old rates, and they're not making any money, essentially, because obviously they're tied in for fixed rates on maybe a rate of 2.89% on a 5-year fix. And now it might be late 4s, 5s. That's the margin of difference. So the margin differs per lender, but I think the sentiment should be that the rates are, especially in the buy-to-let specialist world, are being forced up by the cost of funding at the moment.
As someone with their finger on the pulse of the mortgage world, what headlines are you seeing that we may not be paying too much attention to that we should be?
Building societies have pulled out the markets at the moment. The sentiment there is that they're managing capacity. And they want to see how things are going, essentially, and see how to price things in the future. Like we said, cost of funding is increasing weekly. So I think lenders are unsure about their pricing. So some building societies are pulling out the market. It's an uncertain time, and I feel everyone in the market wants to see how the next few weeks and months pan out, really.
Are you seeing any difference between residential and buy-to-let products, or within buy-to-let between personal name and buy-to-let products, or is everything just going up across the board?
With buy-to-let, personal name and limited company, there's always a difference in the rates. There's still a difference in the rates at the moment, but obviously that's a tax question as well. So it's important clients have a holistic kind of understanding of not just focusing on the interest rate, but if they are buying a limited company, what implications are there to get access to profits. With residential, some lenders are still offering 95%. Again, those lenders will offer those products to certain clients. Yeah, and it goes back down to capacity again. It's also important to be responsible with any borrowing. Mortgages are no different. Rates are extremely important, and it's important to be rate focused, but scenarios and LTV are a key factor as well. The assumed borrowing might not be viable. Higher leverage for some lenders leads to higher risk and stress disposable income.
What about choice? Are lenders exiting the market or more entering the market? And what about products too? Are they being withdrawn or revised, or is criteria getting tighter?
There's still a good choice of lenders out there. Everyone's still there and operating, but the key thing is affordability is key at the moment. Certain lenders will be tighter alongside restricting LTVs. But as I mentioned, at the same time, we're still seeing 95 residential products for the right customers. Essentially, lenders want to remain a viable business and attract a certain kind of client, as well as managing their internal capacity.
So from a buy-to-let perspective, which lenders have the best products at the moment?
It's very difficult to mention lenders and products, because everything's driven by a scenario. It's really important that clients are aware of the property you're buying impacts your rates as well as your personal scenario. The cheapest products aren't always the most viable ones. But alongside that, there are still some competitive buy-to-let rates. Bank-backed lenders tend to be cheaper. But I think it's important to speak to the broker of your choice to understand your scenario and where it fits in the market. There's still some mortgage products that fit kind of standard buy-to-lets and still let investors get some decent cash flow.
Realistically, what kind of rate should investors be shopping around for right now?
I think it's important for clients to run their numbers with some conservative margin at the moment because, rates are changing all the time. It's quite difficult to mention rates. It's changing. I think it's important just to speak to a broker, to do your fact finding, to state your mortgage preferences, what you're doing for the future, how you're building your portfolio, and sit down with someone and project some cash flow for you, really.
Now, obviously, uncertainty in the market and the economy as a whole is going to be on the minds of investors right now. What suggestions do you have for anyone who's looking to make a new purchase?
To speak to a broker and understand where you fit in the market. As I said before, cheapest isn't always the most viable option, and your scenario, and especially in buy-to-let, the property will drive your choice of product. So I really do encourage all clients as a part of their due diligence, instead of focusing around rates and trying to find the cheapest rate, I always ask clients to spend the time to find the right broker. There are plenty of great brokers out there who will give time and context to understand where clients are in the market and where they fit with certain products. It's important for clients to understand, if there is a cheaper product, why isn't it suitable? Clarity and context is extremely important, which will help clients make the right purchase. Have that initial conversation with a broker and perhaps get a decision in principle, but with the knowledge that that rate might change if your DIP expires, essentially.
And what about those on variable rates? Is it a case of hang on in there and lock in a fixed rate when there's more attractive products?
If you're on a variable rate, is it a variable rate kind of initial fixed period? Have you gone beyond your initial fixed period, so your variable rate's quite high? There are lots of quirks there. Again, it goes back to the same sentiment, which I think is really important. And then I do ask clients to just spend the time to find the right broker, because they will provide you context to guide you through these scenarios. I don't think this is something that a customer could qualify themselves, and I don't think they should. For sensitive, costly scenarios, always reach out and find someone to advise you.
So a couple of weeks ago, Rob and I had different opinions on this. Should you be fixing for 2 years or 5 years? Who's right here? It's me, isn't it?
Both are very valid insights into the market. Are you happy with the 5-year fix, knowing your cash flow stable, but when they get to the end of your 5 years, you may be paying a slightly more on interest rate than is currently available? Or are you happy with the risk that if you take the 2-year, you could find yourself in a similar scenario with rates now, and you've got the cost of refinancing attached, broker fees, potential legals, more product fees. If it's specialist lending, you might have a 2% product fee. It's just really down to risk appetite. It is a really costly exercise for what would be an educated projection, essentially, because nobody knows.
Very diplomatic, Nick, very diplomatic. Is there anything else investors can be doing to help themselves? So, for example, if you can afford it, using a larger deposit.
Larger deposits will maximise your cash flows. But I think what this time should be teaching us is to remain balanced. Clients need to manage their portfolios like a business, I think. Mitigate risk. Is it operationally sound? High leverage, 80% buy-to-let mortgages make me nervous. As you all know, capital appreciation is slow in terms of realisation of the funds. Another thing for clients to be mindful of is failing rental stress tests, especially when you're remortgaging. We've seen a few scenarios recently where clients have had legacy lets, often properties that they used to live in that have long-term tenants in, and the rental income hasn't been increased for a while. But in an environment we're in at the moment where rates are increasing, affordability is tighter, when you refinance, you might be failing rental stress tests. Obviously, that moves into a bit of a moral dilemma, because as a landlord, do you want to be putting up your rents in the current climate with the cost of living, etc.? So it's going to be a healthy balancing act, really. And something we're going to have to be responsible with, I think, as investors and landlords.
Now, this is a horrible question, but we've got to ask it. Obviously, you don't know for sure, but what's your take? What's the market going to look like in 2 years and in 5 years?
I think we all need to be conscious of the risks and benefits of any mortgage at the moment, any refinancing we're doing, early repayment charges, try to understand the current climate. We just need to remain proactive, informed and responsible, I think is the sentiment we should be looking out for.
So thank you so much to Nick for joining us there and giving his insight. Mortgages right now, everyone always wants to know about mortgages and what's best, but right now more than ever, it's so important. So for Nick to give his time to the show, thank you. We appreciate it. But Rob, let's focus on the sort of big takeaways from our chat with Nick. And the first one is, to state the obvious, there's a lot of uncertainty right now.
Yeah, big time. But I think it's important to keep some kind of perspective. This shouldn't be unusual. Although there's been an unbelievable amount of political and economic turmoil for the last, how many years? 5, 6? It feels like a long time. It feels like one thing just rolled straight into another. In terms of mortgages, it's actually been pretty smooth, apart from that period for the first, about 3 to 6 months of COVID, when lenders were freaking out a bit and just couldn't do business correctly because they were busy shifting all their employees to working from home and they couldn't get properties valued. That was an uncomfortable time in the mortgage market. But aside from that, the base rate's been so low and the market has been so strong that there hasn't been a lot of uncertainty around mortgages. Now, clearly, there is, and we can't say for sure how the market is going to move over the next 6 to 12 months, although we have spoken in recent episodes about the signs that we're seeing and the data sources that we're looking at to try to project forward about what may happen with the base rate. So that's well worth going back and listening to if you haven't already. But clearly you do need to be a little bit more conservative with your numbers to be on the safe side as a result. But I thought a reassuring message, Rob, was that there are still competitive lenders and products out there.
There are, but they might be just a little bit harder to find than the normal, which is understandable. And something we've said from the dawn of time, well, the beginning of this podcast anyway, is that you should work with a good mortgage broker and one that really understands investment and buy-to-let so they can guide you through this process. Rob and I still today use mortgage brokers. We absolutely do, because it's just not worth our time trying to dig into what is the best product right now. And a mistake I often see people make is they see a product advertised and they go for it, but they were never going to get that mortgage because they didn't meet the criteria. And then they feel pain. And sometimes that pain is even losing out on a deal because of that. So save yourself time, save yourself bother, and work with an expert. And if you're interested in finding out more about Nick, we'll link to his details in the show notes. But I think the most important thing from the podcast, beyond anything else, Rob, was that he said I was right about fixing for 2 years.
No, he didn't. He said we were both right. We actually said neither of us was wrong. But I'm taking that as we're both right. That's how I heard it.
All right, we'll go for a draw. Oh, no, actually, I like your framing. We both win. If you want to win, then our Hub Extra is great for you because it's an app that Rob and I use to be more productive, get more done, be more effective. Sounds like the dream, doesn't it? Well, actually, maybe I'm overselling it slightly. What's quite interesting is Rob and I have independently been using this app and now we're going to come together to share why we like it. And actually, from this day forward, we'll be working together on it. So, Rob, do you want to reveal what this wonder app is?
I will, although I feel a bit uneasy about it because I've been using Trello for such a long time and spoken about it endlessly on the podcast. And I know a lot of people, as a result of us talking about it, have started using Trello and love it. And I've still got a lot of love for Trello. It doesn't do anything wrong. But I have made the shift to Todoist, which is, as the name suggests, an app about things that you need to do. I think what's interesting about it is whereas Trello is not specifically for that purpose, you can use Trello for everything, which means it's really flexible for you to set it up how you want it. Todoist is for one thing, and therefore it's more opinionated. It doesn't give you so many options. It doesn't do quite as much, but because of that, it kind of works a bit better for the one thing that it's for. So in itself, as a means of keeping yourself organised, if you don't have a tool that you use for this already, or you're not happy with the tool that you do use, then Todoist is well worth having a look at. But I have a particular way that I use it that's been really effective for me. Rob, I know you do as well, so you go first.
Yeah, and I find this super useful. I've previously mentioned how you should be taking advantage of shortcuts on your iPhone, and I think Google Android phones have something similar. But Todoist has a shortcut, well, it has actually multiple shortcuts for the iPhone, I'm one of those people that ideas just pop into my head and I don't want to lose them. So I've got a shortcut on my phone on my first page, which just allows me to grab a note wherever I am. So I click it and I'm straight into writing a note, which is great. I also have my to-do list for that day on my home screen, so I can keep an eye on the things that I need to get done, and it's front and center on my phone. So an extra little sneaky hub extra there is that you should be checking out shortcuts for your phone as well, especially for the apps that are going to add something to your life will be most useful. But Rob, I love your method of getting the best out of Todoist. It's a way I've never even thought of using the app, so please reveal, how do you use Todoist to get the best out of it?
You could easily do this as well because it's powered by shortcuts, but this is just using the voice feature of that. So if you use an iPhone, and there may well be a way of doing this on Android as well, but you certainly can on iPhone, you can associate a voice command with Siri with any shortcut and you can customize it as well. And for idea capture, I've found this super valuable because I have tons of ideas when I'm running or cycling, so I don't have my hands free. And I spend a lot of time at the moment holding a baby, so I don't have my hands free. So if I actually have to type the idea out, chances are I'll have completely lost it by the time that happens. So I can just use a voice command to launch Todoist. It'll ask me what I want it to be, so I'll dictate that, and that's it. Then it's captured into the system. Then most days at some point I'll go through my inbox on there and see what I've captured. Sometimes it's a bit garbled. I have to try and work out what on earth I meant. But generally I can take it and move it to the appropriate list to do something with it. So I think, Rob, what we've both said about idea capture kind of transcends any particular piece of software. The power is in just the ability to very, very quickly get something out of your head and into a system where you can do something with it later. Because if you don't, it's either going to keep going round and round in your head and bugging you, or, as it would in my case, just vanish completely.
Yeah, same. So use it as that extra brain, if you like, that's just going to take it away from you right now and store it somewhere else. But then look at Todoist as an app beyond that, because it is really, really good. This show is not sponsored by Todoist, but maybe it should be, Rob, because we've given it quite an endorsement there.
Yeah, no, if that was actually an ad read, I'd be really proud of ourselves with that. But it wasn't. It was a tool that we both genuinely use because that is what Hub Extra is for. And that's one of the reasons that people come back to the Property Podcast every week, as we hope that you will do next week. So we've got another cracking episode coming up next Thursday. Make sure you are following the show on Apple Podcasts or Spotify so you do get that episode sent to you along with all the others. And let us know what you thought about this episode. We're on all the socials at Property Hub UK. We love to hear from you. That's it for today, though, so have a great week and we'll see you soon. Bye-bye.
Bye-bye.